Treasury Secretary issued a blunt warning to Europe's leaders earlier today. He told a conference of EU finance ministers to stop bickering with the European Central Bank and take action on the debt crisis to avoid catastrophic risk to financial markets. Meanwhile, Eurozone ministers at the conference in Poland made little discernible progress in confronting a crisis that has ravaged the continent for the last year and a half. To discuss the latest, we are joined by Alex Trashevsky, founder and managing partner at Recovery Partners. Good to have you back with us, Alex.
Thank you, Howard.
So, one might be tempted to say that Tim Geithner's got a lot of nerve going over there and telling them to stop bickering, given what they just went through in the United States with the debt ceiling.
Well, exactly. I mean, I don't, it's hard to see how this thing is all going to end well, given how it's progressing so far. And I don't think much has come out of the G7 last week. I don't think much is going to come out of this meeting. There's clearly a leadership deficit here, and that's not very encouraging in terms of the future course of this crisis.
But what about U.S. pressure? Obviously, Geithner went there. He's the first U.S. Treasury Secretary to attend an EU finance ministers meeting, obviously to put pressure on these folks.
Well, I think it's indicative of how much stress there is in the situation, how fraught it's become, and how folks are now starting to grasp for solutions. I don't necessarily think the U.S. has any solutions beyond throwing money at the problem, and we saw that announcement yesterday with the offer of central bank support to the Eurozone commercial banking sector. I think that is a very, very serious indication that the crisis has taken another lurch into a more dangerous territory here.
Because the major European banks couldn't get short-term U.S. dollar funding any other way?
Well, yeah, and it's kind of bizarre because U.S. banks, with the Fed policy, are sitting on piles, trillions of dollars of liquidity, but they're not releasing it into the market. And so, the dollar market's become progressively starved. The Eurozone banks are, the share prices have been cratering, and the markets have been seizing, the funding markets have been seizing up. These folks haven't been able to get funding in the open markets. And now we're into a lender of last resort scenario, not only involving the ECB, because its resources clearly are becoming stretched. That's what this is telling us. So you've had to involve the Swiss National Bank, you've had to involve the BOJ, the Bank of England, and the Fed. This is not good news.
So will this prevent a Lehman-like event in Europe from occurring?
It's hard to say. It's hard to say. I can tell you one thing: Greece is going to default before the end of the year, and that might be what tips this. But Greece, if we just look at their maturity schedule, they've got $5 billion in bills maturing in November, $5 billion in October, and they've got about $10 billion in bonds maturing in December. They're not going to be able to make those payments on top of their deficit unless they get these payments from the Eurozone.
The bailout.
Unless the bailout comes through, and that's also iffy. Greece is right now on the knife edge, and that could be what tips it. The other thing that could tip it is run on a currency, whether it's the U.S. dollar or the euro. Who knows?
So what about what Gordon Brown said, that the euro, he spoke at a World Economic Forum event in China today. The euro cannot survive in its present form. It's going to have to be reformed dramatically. We are, I think, at an hour to midnight in the way we look at this issue.
Well, I completely agree. Because what we have here in Europe that's been building over the past couple of years with the Greek crisis is what I'd like to call son of subprime. I mean, you're lending money to the Greeks. The EFSF is borrowing money from the market. It's being packaged up as AAA, but what's really backing it are loans to a double C borrower. So it's like a kind of packaged up subprime note that's basically got bad sovereign debt inside. That's eventually going to have to be paid for, I believe, by the European taxpayers. You've got a son of subprime situation there, and that can't end well.
Which of course cripples any growth prospects.
Yeah.
Which creates a vicious cycle.
Yeah, they revised downward the Eurozone growth prospects for the third quarter of 2011. I think we're looking at flatlining growth of around 0.1 to 0.2% now, according to the official forecast. You've got no growth in the Eurozone.
Can you contain a Greek default?
It's becoming less and less probable as this crisis is allowed to drag on. what's needed is a controlled meltdown. And the authorities so far haven't displayed the leadership, the cohesiveness required to have that controlled meltdown occur. Had they initiated this policy a year and a half, a year ago, you would have been looking at a write-down of maybe 20 to 30% of Greek debt. Now you're looking at a write-down of 70 to 80% of Greek debt on a much larger base of debt. And so the possibility of controlling that type of a situation, if it's allowed to spin, is much, much less than it would have been a year and a half ago. Much less. The longer you get into the situation of lend, borrow,